My name is Mark Mosley. I've been trading options for 10 years. I'm a full-time trader. I've tried a lot of different approaches. If you've heard of a strategy, I've probably attempted it. And there's a pretty big learning curve in this business. So part of my effort to give back to the community is to do these little talks for the group. I think this is my fourth or fifth one I've done on various trading topics, and trading is kind of a journey. You never really know it all. It's kind of like practicing medicine or something. You never really know it all. So anyway, welcome, and let's see. Well, so anyway, my experimentation with calendar spreads started about 2 years ago, and I've done really well with them. And I started focusing on calendar spreads because I had tried broken wing butterflies and the 20, 40, 60 approach and all these different things. And I would make money for a while and then start losing money. And I never quite understood why I kept getting blown out of my broken wing butterflies. And one day it dawned on me that a broken wing butterfly is a short Vega trade. It benefits if volatility falls, but it's hurt by increasing volatility. So if you're familiar with the broken wing butterfly, there's a big risk area to the downside, and if the market moves to the downside, you have increasing volatility, which is just the double whammy on the broken wing butterfly. And so I found a better way, and I want to share it with the group. And so let me page down. Okay. A small disclaimer, I'm not an investment advisor or broker dealer. You've heard this kind of stuff before. Information is presented is hypothetical. It's for educational purposes only. My performance is not indicative of your performance. So I've been working at this 10 years, so don't think that you're going to do this the first day, but don't trade with money you can't afford to lose. And if you are not familiar with this publication by the CBOE, I would encourage you to read it and get familiar. And here's a little bit about my background again. I've been trading for 10 years, taking options under some of the top educators. I'm full-time trader and do one-on-one consulting and mentoring, blah, blah, blah. So a little trading footnote that I like to throw out that most people, some people may not be aware of, is there's a tax advantage to trading the SPX, the Russell, and the NDX. So, I do a lot of work in my IRA, which is a retirement account, and this is not really an issue in a retirement account, but I still focus on the SPX and the Russell for this reason and other reasons too, like no earnings calls, no analyst upgrades and downgrades, etc. So if you're interested in that, consult your tax advisor. Okay. So what is a calendar spread? I mean, I'm assuming everybody knows what puts and calls are. And so a calendar spread is a combination of a bullish position, which is selling a put, short dated. That's a bullish position. We also have a bearish position where you're buying a put, a little bit longer dated. And so we use the same strike price on these two. And because we are both bullish and bearish at the same time, we form what's called a profit tent, which we'll get to in further detail in a minute here. And so we are able to make money over a range, plus or minus, where the market's trading right now, without really guessing the direction. So many people who are new to investing are are trying to guess the direction of the market. Well, you know, especially this year in particular, anybody that can guess where the market's going is got to be some kind of genius, because no one knew we were going to be clobbered with COVID and all the other things that have happened this year to bring us crazy volatility. So anyway, so we're bullish and bearish, and we make money with the time decay on the option contracts primarily. And so we'll move right along. Okay, so in options trading, we use this analyze graph. This is from Thinkorswim. We use this analyze graph to understand what we are doing with these puts and calls and things. And so to help you understand this trade on a basic level, this is what buying a short put looks like. We're selling a put about close to at the money. Okay, so on this graph, the zero line is our neutral. We haven't made any money, we haven't lost any money on the zero line. And then I'm assuming everyone can see my cursor. You know, we have plus money on.
Yeah, we can see the cursor. You might want to maximize that though, Mark.
Wonder how I can do that. Full screen, zoom in. Well, there we go. I'm going to have to get back to the other view in a minute here, but you can see in detail that the zero line would be our neutral level on our options trade, and then down below that we're losing money. And so on this graph you have two lines. The purple line is our what we call the T plus zero line, or our current scenario. So we would be at zero right now if I just put this trade on, but ultimately at expiration you would be up here on the blue line. And so you can see you can make money from way down here. And so the potential prices of the instrument are on the horizontal axis here, whereas most charts that we look at, you know, like you know, a normal price chart would be on the vertical axis. So anyway, let me get back. Okay, so you can see selling a put, you know, a lot of people just sell puts and generally can make money. You're profitable from way down here all the way up, and you're guaranteed to make this much money at expiration if you just sell puts. But selling puts is a very capital intensive strategy, and it is also short vega, I believe. So you would get clobbered on the downside, a move to the downside. And then you can also see the slope of this line takes us into the negative territory very quickly. So just selling a put, if the market goes down, we can be drawn down several $1,000s very quickly. And if we really take a crash, you can bleed out heavily quickly. So now a long put, this is a graph of the long put. So you can buy a put. If you think the market's going down, you could just buy a put. And so your T plus zero line is here. And so if we gap down heavily like tomorrow, you would be up money. But you also have time decay working against this strategy. So at expiration, this purple line would come down to meet this blue line, and you would be down money. If we only went down a little bit and then we continued to go sideways, you would eventually be losing money, and then at expiration, you would be down pretty significantly. And so we don't like this strategy because it's negative negative theta, which is time decay. We're paying out time decay. And so, but the combination of the two, the long and short put combined, looks like this. And so this gives us a profit tent. We are able to make money from way down here to way up here. You know, I have no idea which way the market's going tomorrow or the next day or next week. But if I can ride it out. I mean, oftentimes the market will chop sideways for a significant period of time. And during that period of time, this T+0 line rises over a range, and you can easily be up, 10, 20, 30% after a few weeks sitting on one of these trades. And I myself have been doing this for 2 years now, and I have netted my account in excess of 100% return this year with this strategy. And I think if people realize that you could make that kind of percentage return on this, that more people would pay attention to this. So many people are doing this and that and making a few percent, and they're losing a few percent, and they're not making any headway. But you have to look back at your performance over a period of time, and if you're not making a decent return, you need to question what you're doing. So anyway, as I said, I've done over 100% return in my account this year in this crazy market through COVID and everything, trading this. So anyway, we'll get into some details here. Let me see. I see a question. Please compare put side and call side, short term and long term, and adjustments. Okay, we're getting to all that. Okay, entry rules. So I've come to this through trial and error, and I'll explain more in detail why I picked these numbers. But as far as volatility goes, generally I'm entering any old time except during a volatility spike. So how do I know a volatility spike? I'm probably watching the VIX. And, if it's a crazy day in the market, don't do it. Otherwise, jump on in. And if you manage these the way I will explain, you should do okay. So we're going to sell a short, an at the money put or call, either one. I've traded these both in the puts and the calls, but generally favoring the puts. That might be an area to study further, but 60 to 80 days on the short leg, and the long leg about 30 days beyond. So so many people try to do a weekly or whatever, and I'll show you why that's a bad idea. But these timed expiration numbers are key to my success in this, I feel like. And so don't go making up your own numbers if you do this. So let me move right along here. All right, here's the problem with the short-term calendar. Okay, this is one, I graphed this out. This is 1 week to expiration on the short leg. Let's see, I mocked this up the other day, and I'm just looking at the date. So this would be selling an October 26th put on the SPX at 3,500 and buying the next about a month out, November 27th put. You'll notice that there's a lot of slope to the T+0 line, and we have a very narrow range of safety. So at expiration, our break-evens are this little red hash here and here. We'll at least break even at expiration way out to here and to here. But as the market's rolling up and down, you have no clue that it's going to stay within this boundary. And as you start riding down this slope, let me see if I can zoom in here, because this is a key point too. Zoom in. Okay, this shows it pretty well. So if I was to put on one of these with a week to expiration, it's a very quick slide down this slope, and you're losing money down here. Remember the break-even line is this solid, this dotted gray line here. So say you put this on thinking, oh, I want to make money quick. Well, we all want to make money quick. But and then the market takes a dump tomorrow. Just even by 20 or 25 points, we could be down some money, and we have no guarantee that the market's not going to go down further. And then you're down here, and then you're like, oh, well, I'm down $1,000. Do I lock in my loss and get away from this mess, or what do I do? This is a very tough trade to manage here, because we really, the part that is close to break even is really only from about here to here. We got like a 15 or 20 point range on the S&P on a weekly trade. And so this is why I don't like this. This is very tough trade to manage like that. And so when you put this on like I do them, you have this very shallow slope to this T+0 line. It takes a big move to really draw down much. And even if you're way down here and you're drawn down a little bit, you got some confidence that you're still under the profit tent. And if the market continues to crash, well, it's a very gentle dive into the negative numbers here. And we'll get into discussion on volatility and how that affects this in a moment also. But the point here is that it's a very wide range of safety over a lot of numbers up and down, and a very shallow sea of death. If this was a live chart, I could drag this to the right, and you could see how much how much you could lose here. But $26.30 debit, we're about a $2,600 trade for a one lot here. So the max you could lose is $2,600. But if you could manage this thing and let it get up into here, I mean, the potential to make 100% return is there. I usually don't chase them to that extent, because well, we'll get into that later, but it's easy to make money with this over a large range up and down. And so this is the beauty of being, starting out with at least 60 days expiration. And so moving right along here, what about the Greeks? So I don't want to scare people about talking about the Greeks. A lot of people decide they want to trade options, and then they think, oh, Greeks are too complicated. It's not that complicated. In fact, it's very simple. And so this is my interpretation of the black shoals, and I've simplified this for the sake of beginners, and don't want to get too technical. When I talk about the Greeks, I'm not doing any complicated math or solving for any equations or, calculating standard deviations. I'm not doing any of that. And maybe if I talk about this a bit more, you'll kind of get my drift. So, the options price, if we're going to trade in options, we need to have some gut instinct of what influences option price. And so it's basically delta plus theta plus vega equals option price. And so these are not textbook definitions. This is the way I think of these things. And so delta is a measurement of your directional risk. So if your delta is 0, your trade can tolerate the most movement in the market. We don't, like I said before, we don't know if the market's going up or down tomorrow. It could go up big tomorrow. It could go up down big tomorrow. We just don't know. The potential for crazy news stories to move the market is definitely there in this environment. And so delta is a measure of our directional risk. It can be positive or negative. 0 would be totally neutral. You could be a little bit delta negative or a little bit delta positive on your trade, and I will show you how I watch those figures and what that means in more detail. But theta is our positive money flow. We want a positive theta all the time. if your trade is showing a negative theta, you are losing money with the passage of time. We never want to be in the position of losing money with the passage of time. If a trade gets away from you and your Greeks are out of whack, you always have the option of just closing the trade and going to cash and starting all over again. And so anyway, theta is a consideration, and vega is our sensitivity to changing volatility. Volatility can have increase or decrease all the time. Trying to predict which way volatility is going is almost futile. It would be just like trying to predict which way the market price is going. We have no clue, and so we want to manage the options to our best ability to minimize these risk factors. I mean, volatility is a risk factor. It can help you or it can hurt you. And if you were trading options and you have no clue what your vega exposure is, you're wasting your money, and you need to understand volatility to a greater degree. So anyway, let me move along here. Okay, this is delta neutral trading. Since the market can go up or down at any given time, we try to structure our trades so to be minimally affected by price moves over a given range. So anyway, I've said some of this already. So where do we see the Greeks? So they're down here under the price slices on our analyze graph in Thinkorswim. If you're using another software package, it'll be somewhere else, but this is how I have my chart set up. Delta, gamma, gamma is another one of the Greeks, and it is a risk factor. If you use my time to expiration recommendations, gamma is not all that much of a consideration. So we're not going to worry about that one too much, but this is an example of a new entry, and you can see my delta is a 0.55, which is essentially neutral. So if the market goes up, let me see, delta will be positive. Let me see, if it goes up, the delta will be negative. If it goes down, it will be positive. And so the plus or minus sign gives you an indication of which way you would prefer the market to go so that you get back to the neutral point on your graph. Now, we're not going to adjust every tick of delta. Generally, plus or minus about 30% generally works fine. And I look a lot at my delta theta ratio. So when I say 30% delta, I am dividing my delta by my theta and coming up with a percentage. And so you want a small delta, you want a big theta. Theta is how we're making money generally, and delta is a risk factor. And so we'd like to be pretty neutral on that. And then vega, I will talk more about vega. I'm not sure that the numbers that our trading platforms give us for vega are all that accurate. Ron Bertino did an interesting presentation on weighted vega, where he argued that vega was essentially neutral on calendar spreads. And I'm not sure that's the true story either, but we'll talk about that some more. But just so you know where the vega number comes from, it's right there. And so, yeah, so here we talk about the delta theta ratio. Delta, how far from direction neutral are we? And theta is a measure of what we're being paid to take that risk. So we want a small delta, big theta. And let me see, delta positive, we want market to go up. Negative, we want market to go down. I already mentioned that. Let me see, I think we've already kind of covered this stuff. Okay, management rules. We want to keep delta under 30% of theta. If trade is threatened either on the top or the bottom, we're going to add a second calendar. Now you can do that by splitting the one you got in half, taking half off and reallocating that money. Or if you've got other cash in reserve, you can save that to add a second calendar on top. And I've got some pictures of those as we go along. It would be a double calendar. It looks somewhat like an iron condor on the graph. And I'll manage the two trades as a pair, keeping my delta theta ratio under 30%. If we're threatened again on the top side, so we've got two calendars on and the market keeps moving to the upside, usually what I'll do is start peeling contracts off my lower calendar and adding a third calendar up on top. And by if we're trading a instrument where we can afford to have a lot of different contracts on, I mean a large number, you can incrementally do this rather than taking your whole lower calendar off. You might just take a few contracts off your lower calendar. So you can incrementally adjust your Greeks and adjust your trade position as you go. But that will make more sense later. Let me see. Okay, try to ignore managing according to profit and loss amount. This is something traders do a lot. You might be in one of these and you might have an adverse volatility move. And I'll discuss more about volatility, but sometimes you can have a situation where your T+0 line falls. Let me get back here. Sometimes the T+0 line can drop. You might still be comfortably under the profit tent, but a change in volatility can drop this whole line to where you're not profitable anywhere, but you're still under the profit tent and your Greeks are still fine. And so the lesson here is to manage according to your Greeks, not according to your profit and loss. You know, I can be in this and be drawn down and still be sitting in the middle of the profit tent. And so it's just a waiting game. You know, trading these gives me a lot of flexibility that I can put these on and go work in the yard, do errands, pursue hobbies, whatever I want to do. So this is a big lesson, and this is why I've got it in bold. Don't try to manage according to your profit and loss. So this is a trade where we've had to double up. So we initially started with a single calendar right here. You can tell where they are from the peaks on your graph. It would have been right here. And we started getting close to the upper end on this one. And, you know, maybe you have to look at the price chart in context. Say the market was ripping to the upside and we felt like we were going to blow out the top. I add a second one on and it extends your range. And so look at this range that I'm sitting on. This is a huge range where day to day, there's just not that much to do. You can sit on this and you just make money with the passage of time. And so, you know, my rule is delta theta, keep it under 30%. And if it gets way up here, that's when I start peeling off contracts down here and adding a third one. And as far as the spacing goes between each calendar, I'm using the Greeks as a guide. Again, I want a neutral delta and a big theta. And so, you know, but I'm also trying to do some rudimentary technical analysis on the price chart and decide, are we at resistance or support? You know, how high do I think the market can go in the short term? Are we going to blow through previous highs? Are we going to blow through previous lows? And where are those previous highs and lows? Those are all questions I kind of ask myself as I'm making decisions whether to add or whatever. So that's some of my thought process here. Okay. Are you guys still here?
Yeah,
I think I just
yeah,
something
we are.
something happened. I lost right.
It said PowerPoint is restarting, but you've restarted it fine.
Yeah. Now how do I get the full screen again here?
You can go to view.
View. I'm in normal.
You can go to reading view, I think.
Reading view. Okay. All right. I don't know what happened there. Let me get back where we were. Entry rules. Okay. Okay. So how are calendar spreads affected by volatility? This is a big issue in option trading, and so many people try to trade options and really have no clue about how their trade is affected by volatility. So calendars are classically described as a positive vega trade. And that's not totally true. It usually is true, but I've seen them behave as a negative vega trade as well. And so they can really go either way, and I'll explain why. And the reason why has to do with the term structure of volatility, how volatility is changing over time, moving into the future. So volatility is really our option price. If volatility goes up, our option prices go up. And that's because option prices are really, it's an insurance premium. It's an insurance that huge market participants buy and sell as hedges to their portfolios for all different reasons. It's essentially a insurance instrument. And so if a big news story like COVID drops on the market, you see volatility go through the roof, and how the severity of your news story that's moving the market can influence the shape of the VIX futures curve, which is essentially the term structure of volatility, or how the pricing on your options is changing, because we are using two different dates of options. And so in this example here, I've kind of set this up as a new entry. So the red line is the leg we sold at 60 days, and the green line is the option, the leg we bought at 90 days. And this is the shape, the normal shape of the term structure is increasing over time. Now, this is not our current picture, but this is kind of a typical picture. And so in this example, the one we're selling and the one we're buying have a very similar volatility, and so they are the risk premium in each of these option contracts is similar. And so, but what can happen is these things can move independently of each other. So like if we get increasing volatility, it could be a news story that jacks up volatility more in the short term and less in the long term. Maybe the market sees this as a short-term risk, but maybe not a long-term risk. And so you could have increasing volatility in the short term that doesn't affect your long-term pricing as much. And so because these things can move independently up or down, your trade can behave either as a positive vega trade or a negative vega trade. So in practice, what I've seen is usually it's somewhat neutral. But when we had the big COVID scare in March, and everyone felt like there was going to be bodies in the streets next week and all this kind of stuff, the term structure jacked up, affecting the longer leg that we bought as well. And so if volatility goes up on your long leg that you've purchased and all of a sudden it's worth more, you're making money on the increasing volatility on the long leg. It works opposite on the leg you've sold. If we've sold this leg, we really want volatility to go down. If volatility goes up on your short leg, that's going to be hurting your position. And so really what is important to know as far as trading these day in and day out is we don't know which way it's going. But usually if we're under the profit tent, everything works out. And I'm still doing research to try to optimize my trades with respect to volatility. But I've found for the most part, it works just not to worry about it, because we don't know what's going to happen. If you manage your trade properly and adjust your trade at the right times, it's not going to be an issue, and you'll make money. And so this curve here is what a normal curve would look like. And let me see what I've got here. So this is what I just talked about. In options trading, implied volatility is how the market is pricing in risk. Normally shorter term contracts have a lower IV compared to long term. In a calendar spread, short and long leg implied volatility can move independently of each other, which can give counter spreads both positive and negative Vega attributes. In practice, this is normally not a problem since IV is mean reverting. But this is the dynamic when the COVID scare was first announced and Trump got on TV and said, we're shutting the country down, and the market went crazy. My counter spreads exploded exponentially in width. I was safe over maybe a 600 or 700 point range on the S&P. So having such a wide range of safety, I just did nothing and sat on my trades and did very well. So anyway, this is stuff you need to know. But if this is confusing you, I would say don't get too wound up about it, because it's usually not an issue. But these are some of the finer details. You know, if you're trading bull put spreads or condors or really anything, you need to understand how volatility affects your trade. And so many people just look at that expiration graph and they say, well, if it just finishes between here and here, well, you know, usually it doesn't. So anyway, so these are our volatility curves over the past month, which are kind of curious here. And for some reason, volatility has been falling across the range since early October. You can see this this purple line right up here would have been our curve back on October 2nd, and throughout the month, we've been steadily falling. And so I've penciled in here where we might have sold and bought a calendar spread at 60 or 90 days. I don't know the explanation for why the volatility curves are falling. Apparently, the market is pricing in less risk now than they were in early October, which is kind of odd with us 2 weeks before the election. But this is what's happening. And so, you know, apparently major participants in the market are seeing less risk moving forward. And I don't know if that is predicting a win of any certain party or not, but it is what it is. And there's a lot to be learned by following these curves. And you can get this graph at VIXCentral.com. And what I do is click on historical prices, and then click down here on the lower right, multiple days per graph, and you can go along here and select your dates and make up any kind of graph like this to kind of see what's going on in the market. So let me move right along here. Okay, this is a different way that I have found to look at what's going on in volatilities. And so there's several different VIX instruments. There's a 9-day VIX instrument, just which is the white line on this graph. And I did this a few days ago. Let me see. No, this was the 19th. So the 9-day VIX has been steadily falling until like, was that last Friday? No, a week ago, last Friday. But you can set up a toss graph like this. So the white line is the 9-day. The light green is our 30-day VIX, and then the darker green is our 3-month VIX, and the red line is the S&P 500. So, or the SPX. And so, you know, I watch these and try to decide which way I think the market's going based on this. But, you know, generally, if the volatility is falling and the SPX is rising, that's a bullish sign. Now, we've had times when volatility was rising, maybe not on this chart, and the price was still rising. And so that's kind of it's a signal that the market may turn. So anyway, moving right along. So I've kind of talked about this. They can be both positive vega or negative vega. Generally, they're kind of neutral. I usually don't see big swings in my P&L, or you would see it on the graph from the T+0 line moving up or down, and the whole graph can move up and down in a calendar spread as well. Let me see. So we've kind of talked about all that. Okay. So, okay, remember, we sold a short dated leg. If volatility goes up, our position is hurt because the leg that we sold is all of a sudden worth more. And so we didn't get enough money for it. And so we're being hurt from rising volatility on the short leg. The long leg, if volatility goes up, we benefit because it's an asset we bought and all of a sudden it's selling for more. So we benefit from increasing volatility on the long leg. And so when I made all that money back in March on the COVID scare, it was most likely because the implied volatility of my long legs was going up through the roof and made a lot of money for me. So, you know, so many things, people are not prepared for the downside, and this gives you some level of protection on the downside. So how do we handle changing volatility? We manage according to the delta theta ratio, and don't watch your profit and loss figure so much because it will bounce around. I trade these calendar spreads in 10 and 20 lot sizes, which is pretty significant size, and I see pretty large swings in my profit and loss. It can be plus or minus $3,000 in a day, and I can still be okay. Looking at my delta theta ratio and my position on the graph under the profit tent, I can be totally fine, yet maybe I'm down 3,000 on the day. It's not to worry. You just sit on the trade and make money. Let me see, because volatility is mean reverting, you know, these swings usually aren't a big problem. If you see a whole bunch of money come streaming into your trade all at once, you might want to just take profits and wait a few days to re-enter. I've had days like that where I was up over $10,000 in a day, and that's definitely a signal to maybe just take profits. You don't want to look at your expiration graph and think, oh, well, I'm gonna make $70,000 if I sit here till November 20th, because something always happens at the end to take it away from you, and you'll find that you'll make a lot more money over time if you have a reasonable profit target of, say, maybe 15%, 15 to 20%, and close your trade out and move it farther out in time. Being farther out in time takes a lot of the risk away from these things, and so that's a big reason for my timed expiration recommendations. Let me see. And because we're theta positive, time heals all wounds, usually. Now, I can't say I've never taken a loss here, but if the market moves too much, I will go on and close a trade, whether I'm up money or down, and recenter it on the market. So that's just a little of my thinking there. Most of all, don't panic because you're seeing your profit and loss jump around, because that will happen. And anyway, so here's some examples of calendar spreads in action. And maybe this is obvious by now, but as time goes on, this purple line increases over a range. And usually when we have increasing volatility, it will expand this graph, the expiration graph, which expands our break evens farther. And so when we had the huge volatility increase in March during the COVID scare, these graphs increased tremendously in size, both to the upside and the downside. And so here I am under the tent, and this tent is increased 3 or 4 or 5 times its size that I started with. And so there wasn't anything to do but just sit on it and make money. And you know, it was so far either up or down for me to be in a losing situation that it would have been foolish to get out. So that's some of the way these things work. Let me see here. I've modeled out an 8% volatility increase affecting each leg equally. As I've explained earlier, you know, the volatility change can affect the legs differently in terms of percentage. But just for this example, you can see that this is actually the same trade as this one. But with the increase in volatility, our profit 10 has gotten bigger, and our T+0 line has arced even outside of the profit tent. So we're currently, you know, way outside the profit tent with our break even on the T+0 line. And this is a really comfortable position to be in right here. It's a very gradual slope. If you start getting a lot of slope on this T+0 line, you're probably late in the trade. You know, like I said, I want to put these on with the short leg at about 60 days. Well, if the trade gets under 30 days, I'm really looking to get out maybe. And if I'm still situated really well, I may ride this as close as 20 days to expiration. But that's just some of my thinking and the way I manage these. If I'm well positioned and I ride it to 20 days to expiration, you can be up a very nice percentage. So anyway, moving right along, typical entry. I think all this maybe is obvious by now. I showed this on my previous presentation about these, but this is another way to show this in Thinkorswim, and you can show a curve. These are 10-day steps. So you change this. Let me just zoom in here. So you can change this ticker up here to 10 and change lines +4 at day step. And it'll give you a line what this graph would look like every 10 days. And you can see as time goes on, your break evens extend both to the upside and the downside, and the level of money you're making goes up and up. So this was a small trade I modeled out here, but that's an interesting view on these. This is a double calendar, and this you'd be up a decent amount of money here in the middle, and you may decide based on the slope here. I don't really know the day's expiration on this. This was something I did last fall, but when I'm looking at this, I'm seeing a fair amount of slope developing on this T+0 line. So you may be thinking I'm sitting in the catbird seat right here in the middle of this thing, and you might be right. And so, I am always faced with a day-to-day decision-making process on these. Do I want to take profits and get out, or do I want to stick with it? If the market ripped down big from this level, you'd be riding down this curve, and a large part of your profits could evaporate quickly. And then the next day, you would be faced with the decision of, well, are we going to gap down another leg, and all of a sudden I'm losing money on a trade that I was up a nice percentage? So don't let your profits slip away. Nobody ever went broke from taking profits. So anyway, in this view, I would probably sit on this trade a few more days, but if we made any move to the downside, I'd probably go on and book my profits and roll this thing out and start all over again, because the new entry, you have a very flat T+0 line, which eliminates a lot of your risk. All right, this is a live trade example, and this is from a while back. This was in November. But this one, I was up 12% after 19 days in the trade. I mean, some people don't make 12% all year. So why wouldn't you want to do some of this? So after 19 days, I'm up 12%. Started this trade at 69 days to expiration, now at 50 days. I mean, you could certainly take profits on this and roll it out again and start all over and make 12% every 19 days, and you'd be doing very well at the end of the year. Or you could sit on this a while longer and see if you can get up here. But don't think you're going to ride it all the way to the top. Yes, in this example, if we finished up here, you could make $70,000 or something, but the likelihood of that happening is very small, because something will happen at the last where you're up big, and then all of a sudden you're struggling to break even from a big move in one direction or the other. So managing your wins is a big part of this too. And so I like to take profits at I usually don't stop at 15 at 12%. I'll let it go to 15 or 20, but generally that's some of my thinking on this. Let me see. That would be the same trade projected forward in time to 30 days to expiration, hypothetically up 24%. So that would be a great time to get out. If you're up 24%, and you're 30 days to expiration, go on and get out and start all over, bank that money and do it again. So now we have most aggressive management rules. I've been talking about 15%. I mean, you can let this go, but you risk having the thing get away from you. And so here's some recommendations. Consider taking profits of 15%. I have let them run to 30% or greater. But these are some decisions you can make on your own. Let me see. My recommendation is close with 30 days to go, but sometimes I'll let them go as close as 21 days or 20 days or something. But by that point, your gamma becomes a factor. The trade can just get much harder to handle close to expiration. We get a lot of slope in the T+0 line. You can easily get blown out with a 30, 40 point move in the market, and we don't want that to happen. And so you're much better taking profits, recenter on top of where the market is, and keep doing it over and over. And so, wait a minute. There we go. Let me see. I think this is just repeating myself. Conservative strategy would be to take profits at 10%. All right, so we've talked about all that. If you're ever unsure of the market, if there's some crazy news story that's got you worried for any reason. Now, like I've shown, I've traded this through some crazy news stories, but going cash is always an option. And part of this is its visual position under the profit tent. Yes, I'm using the Greeks, but also visually, if I'm getting too close to the top of the profit tent, that's when to start either layering on a second or third butterfly, calendar spread, or taking action if it's getting close to the top of your tent. And so these are footnotes, areas for further study. Got my previous presentation on the 20, 40, 60 butterfly trade, which is a negative Vega trade. And I don't really trade that anymore, but I made a lot of money doing that for a while. And so there's the URL for that. I did another presentation on calendar spreads last year. This one I've just done has been, updated with my most recent experience. An interesting talk by Ron Bertino on weighted Vega is linked in here. Of course, Brian Johnson's books on hedging and risk management are always very good, and I learned a lot from reading his books, and also his book on risk return ratios gets pretty heavily into the Greeks, and it's very good reading. And anyway, you can throw me a few bucks on Venmo if you make a lot of money. I would enjoy that. And anyway, good luck to everyone, and I'll be glad to answer questions.
Well, that's great, Mark. Thank you. There are quite a few in the transcript already, so I have a feeling you might want to go through that and
okay, let's see.
You can find it. And then I would say to people, let's save. We'll have some time a little bit later for longer contributions, for longer statements. So let's say people, let's keep the questions short for now, so that Mark can get through everybody. And then let's say sometime after 8 or 8:15 or so, those of you who have longer contributions can share your screen or whatever and make a 10-minute or whatever contribution. But for now, are you able to find the transcript?
Yeah, let me see. I'm just looking. I'm going to start from the bottom and move back, I think. So Richard says, let's see, main risk with short-term calendars is directional risk. Main risk with long-term calendars is IV risk. Yeah, probably so. Delta theta ratio, most of the delta we saw was around 1, and theta was a bigger number like 30. What is the percent calculation in this? Well, 1 divided by 30. Yeah, you just simply divide delta by theta and you get a number. And so We'd like to keep it small, and 30% is just kind of an arbitrary number that I've come up with through experience. Usually it stays small. If you're later in the trade and way out on the wing, though, that's when you can get those numbers going haywire. And I hope that helps. Let's see. How do you calculate the delta theta ratio of a diagonal for two diagonals? Well, okay. Let me drag. Hold on. Let's see. So your delta. So no matter what your trades are stacked up down here, you will have your Greek numbers here. And so if I had a diagonal or two diagonals here, it would give me the same numbers. Now the approach that I've used here is not really applicable to diagonals, even though a diagonal is generally considered a positive vega trade. Also, I have not had I've traded diagonals, but I have not traded them extensively while looking at the delta theta ratios on those trades. Usually the way I've traded diagonals have been more of a directional approach. And in a directional approach, you would certainly have a bigger delta. So that's really a different strategy that is beyond the scope here. But yeah, I like trading diagonals too. I use them oftentimes for a directional play on a certain stock that I feel like might go up. I like the risk reward on these time spreads, and a diagonal is a time spread because you'll have two different expirations. So the delta theta ratio may not be applicable on a diagonal. Let me see what else we got here. John says, do you have a quarterly? Okay, yeah, I trade any of the, whether it's quarterly or weekly. I'm mainly looking at the days to expiration. So I don't exclusively do this on monthlies, although I prefer the monthlies. But it just depends. Sometimes, maybe I close out a portion of maybe I've got 3 calendar spreads on, and the lower one's getting to be kind of out of play, and I may be up money on the lower one because I've been in it a while, but because it's way from at the money and it's becoming out of play, I might just take the lower calendar off and then see how the Greeks are on my upper 2 calendars. And in that case, I might have extra money left over from closing out my lower calendar, and I might reposition that into another trade. And if it's getting to be shorter to expiration, say we put the thing on with 60 days and now maybe we're 35 days. I don't like to keep on. I mean, I will do some adjusting at around 35 days, but if we start getting much below that, I start wanting to move that money farther out in time to manage my risk on that money, because when you first put a trade on, you've got the super flat T+0 line over a huge range, and there's just very little worry. But when you've been in a trade and you've adjusted and it's around 30 days to go, it can be a little bit hard to handle, and it's awfully nice to just move that money farther out in time and eliminate that risk. So anyway, let's see what else do we have here. Tom Clark says number of wins versus number of losses. I haven't really tracked that number. It's pretty good. My losses this year have been small. you know, I kind of look at all this as a campaign trade. You know, John Locke does a lot with campaign trades, and you have to have option view or something like that to keep track of them. And you know, that's all well and good, but you know, to me, my entire trading career is a campaign trade. And so if I've made money on a certain portion of it, or I lost money on a certain portion of it, I'm not letting that get me wound around the axle. I take the profits and try to make money on my money while exposing myself to the least risk possible. And so, you know, it's all a campaign trade, because I might have three different butterflies on, I mean, three different counter spreads on, and then, you know, like I said, maybe the lower one's no longer really in play anymore. And so I'll move it farther out in time. And so sometimes I'm managing two different time series of these, I'll have money that I'm putting in with the short leg at maybe 80 days to go, and the long leg 30 days beyond that. And then I'll have another series of these that I started with 60 days to go, and now it's 45, and so they haven't quite played out. But anyway, so I roll the money around based on timed expiration, and anyway, it's all a campaign trade. Let me see what else. Richard, main ones. Okay. Richard's talking about the VIX indicators there. Oh, that's Ron Bertina. Let me see how many different VIX duration symbols are there. Okay. Is there a certain? Okay, Alan asked, is there a certain IV difference between front and back month that you would not place the trade on? Not really. You know, this is an area for further study for me and everyone else, because I'm sure there are ways to optimize your trading in terms of implied volatility, but because it can go up or down, and you know, the up or down can affect the front leg and the back leg differently, certainly, and we don't know the magnitude of the potential coming move or even the direction. I've found it's just something that you kind of have to let happen over time. I know Tasty Trade says, well, try to get a higher IV on your short leg than your long leg, and that would certainly be an ideal situation. But even if you got that entry, you might have to wait a long time for that particular situation to evolve, and then you know, who's to say that you still don't experience an adverse volatility move. So my approach has been to not worry about that too much, because we can't control it, we can't predict it, and it is mean reverting. As long as we're under the profit tent, it's usually going to work out for us. And if you're not under the profit tent, you need to think about taking the trade off and recentering on the market. So no, I don't worry too much about the IV difference between the front and the back month. Let me see. Does weighted Vega, contango, backwardation play any role in your strategy? You know, this is kind of what I've been talking about here. And you know, it's something I'm aware of. It's something I would like to maybe develop a piece of software to take advantage of these things better. But really, it's like trying to predict waves in the ocean. They might be big, they might be small, but ultimately it's mean reverting if we can hang on long enough and we're still under the profit tent. It's going to work. Very rarely have I had the situation of falling volatility. Let me see. We can model that out here on the chart, what that would look like. where is it here? So you can adjust your volatility here and you can see what it's doing. So in this situation, now this is modeling a equal decrease on both legs of minus 2.8%. And you'll see we're not profitable anywhere on this T plus 0 line, but we're still under the profit tent. We still have a decent sized positive vega. We still have pretty much a neutral delta here. I'm going to just jack this up to a 10 lot to magnify these numbers a little. You know, in this case, you'd be drawn down $3,100, but you're still right here under the profit tent. So this comes back to what I'm saying. Don't try to manage according to your P&L. If you're under the profit tent and your Greeks are good, which they are in this case, just hang on, and time will bring you back up here, and you may get some reversion to the mean of your volatility, which would also push you back up. So my advice is don't panic about the changing volatility, because it's gonna happen, and sometimes it's your benefit. Occasionally it hurts you, but usually when it hurts you, you're still under the profit tent. You know, this can also model increasing volatility, and you can notice that the whole profit tent is rising at this point. The T plus 0 line is rising, and you know, these may not be realistic numbers that I'm putting in here, but I'm just going to put it back to 0.
Hey, Mark, while you're on that screen, go ahead and check the more parameters box just to the right there, and you can
Yeah.
do each leg individually.
Yeah, I was looking for that. Let me pull that up just a touch. So I've played with this too. Of course, we don't know what, you know, what could be the effect of, you know, on each leg, but you can certainly come up with different numbers. Say your short leg, okay, your short leg would be December. Say it goes up, let's see, 1, and say the long leg goes up by, you know, maybe more, maybe 2. I don't know if that's a reasonable number or not, but you can see what a change in volatility on the long leg is affecting us more than the short leg. I think I've got that right. So, I mean, looking forward into the future, we have no clue what these numbers would be. Even if we knew, you know, even if you knew, say back in January, you heard about COVID in China, and you thought it might be a factor in the United States, you know, whatever. If you had foreknowledge of the news, you still would have no idea what these volatility numbers, how they would change. And it's really it's a risk premium based on how the collective market views the news story or the risk, so it's a bit hard to forecast, but you know, certainly this is one way to model different changes in volatility on the different legs. And you know, I do play with this. I look at the VIX Central graphs and will, you know, play with these numbers. But as far as huge revelations as to how to use this, what's worked for me is to not panic. And if I'm still under the profit tent and my Greeks are good, I'll stay in the trade. And if the Greeks have gone bad, I'll get out of the trade regardless of my P&L. Sometimes I'm up money, sometimes I'm down money. I've only had maybe 1 or 2 times this year where I took any kind of loss. And it's usually a rolling thing. Maybe I've got a counter spread on, the market's moved way up. Some of the volatility has come out of the market on the move up. So you would have a falling T plus 0 line on the move up. And so I would take, sometimes take a small loss and recenter. Sometimes I'll add a second one on there. There's a little bit of a seat of the pants kind of approach here, I realize, but usually because we're riding up and down on such a flat T plus 0 line, I don't lose money and we have a huge range of safety. And anyway, that's kind of my approach. Let me see. Richard uses weeklies. Okay. I don't know if we have more questions.
Mark, they're at the bottom.
Okay, let me see. I'm back down here. Do you prefer puts over calls or just whatever's cheaper at the money? I usually try to use puts, but I have used calls as well. So like if I don't like to put one on and be selling in the money options. So I may center one slightly behind at the money, like in this example, the midpoint here is 5 points behind. I may position it 10 points behind if I, but generally in the middle. And then, so, this one would be a put, but if we kept charging to the upside and I wanted to get in front of this thing, I might do something in the calls on up above, and that would give me a double calendar, and it would look something like this. So I would do this, and then I might move to the calls. And let's just say 35.40. That was 34.40, 35.40. Let me get out in front of it. Okay. And I'm going to drag this back down. And so that would be, adding a second spread would look something like that. And, in that case, I wouldn't want to sell puts way up here because they'd be deep in the money puts, but these are out of the money calls. And so, but I've done them interchangeably pretty much. Now that there can be some pricing difference. So like, the calls on this one are 25.80, and if I change that to puts, it's 27.55. I don't know if there's a benefit or not. I in my mind, I'm going with the cheaper one. If toggle this to calls is 26.60, puts 27.80. This may give some implication as to which way the market thinks the market is going. I don't know. But generally, what I've been doing is using them interchangeably, but I just don't want to sell out of the money options. So that's my thinking there. Let me see what else. Okay, have you tried high option volume stocks like Tesla or Apple for this strategy? Yes, and but it's not my main thing. I really like the indexes because, man, Tesla can really move, and I've had the same problem with Amazon. It can just move big time based on a news story or something, and that stuff is so hard to predict. I mean, the S&P can move big time also, but it's usually something that is a big story that hits the whole market that really makes the market move. And that can blow you. We got a wide range of safety, but it can be overwhelmed by a huge move. And for that reason, I don't really do this on things like Tesla or Amazon. I might do it on Apple, but even on Apple, it's not really my bread and butter trade because there you can have, you got earnings calls which play with the implied volatility in a big way. You can also have analyst upgrades and downgrades, and stuff that affects one stock that may not affect the whole market. You know, the S&P is 500 stocks. So if that thing moves big, it's usually because of some big news story that is affecting everything. And there can be stock specific news stories that really can blow you out of the water. And that combined with earnings risk and the big swings in volatility that earnings presents. I know Liz and Jenny at Tasty Trade use these things for earnings plays, and I've done some of that. And sometimes I win and sometimes I lose, and it's not really, I mean, it's fun to do. It's just a little diversion from my main thing, but it's not something I want to do with $80,000 or $100,000. But what I'm showing you is something that I'm fairly comfortable plunking down that kind of money into one of these trays and just letting it work. So anyway, I hope that helps. Which of the RUT, S&P, or NDX do you prefer? I do these on the S&P and the RUT. NDX is a big instrument with pretty wide bid-ask spread, and so don't really do it on the NDX, but Russell and SPX should be fine. Let me see. What else? John is asking, the delta theta ratio is one way to exit.
Yeah, I think somebody got confused on your 30% exit.
Okay. Did we clear that up? I think we did. All right, let me go back down here. Okay, what are the advantages and disadvantages of choosing between adding more contracts on an adjustment versus peeling off current contracts to reposition them? Well, it may depend on how much available capital I've got sitting on the sidelines there. But it also depends somewhat on how far away my lower leg is, or my lower calendar spread is from at the money. Say if I've got 3 calendar spreads stacked up on top of each other and I'm sitting on this huge range, but you know, my technical analysis is telling me that the market just still wants to go up, I'm certainly going to start peeling contracts off the lower spread and repositioning. You know, but if we were at the top of the market and I felt like there just wasn't enough momentum to go any higher, yeah, I kind of take some of that into consideration, and it's a little bit of a black art there, but I look at horizontal support and resistance levels on the chart. I got so much on these charts, you probably can't really see what I'm doing. Let me see if I can zoom in on some of this. Let me see, can I zoom in? Can you guys see this? This price chart on the SPX?
Yes.
Okay, so, I mean, here our previous high. Now that, you know, I'm looking at the most recent action, but we topped out at 35.88 here. So that's certainly a level of interest. Doesn't seem like we're able to blow through that at this juncture. We got close and then kind of turned around. So that's a piece of information that's telling me, well, it just doesn't seem like we're going to regain 35.88. So I'm looking at my chart and going, okay, well, where's 35.88? 35.88 is up here. You know, if this was the trade I was sitting on, I would feel like, well, I'm pretty well covered on the top side. I don't think we're going much past the previous high of 35.88. So that's a consideration in my positioning of these things. you know, to the downside. There's at least some short-term support here at 3204. So again, 3204, where's that on the graph? Well, 3204 is down off the bottom. You know, if we did take a tear to the downside, you can get some increasing volatility that lifts this T+0 line more than this is showing. So these graphs are it's a computer simulation. This is not, you know, a guarantee of what's going to happen if we drop 75 points, but generally the volatility shift can raise the T+0 line on this side, and conversely on the top side, the falling volatility can make it drop up here. So you've got a little less range than you think you do on the top side, and maybe a little more range than you think you do on the bottom side. So that's just been my observation from, you know, after trading these for 2 years straight, day in and day out, you know, different kinds of markets. That's what I'm thinking on that. Let me see what else we got here. Yes, calendar spreads are debit spread to start with, and it's a credit spread to close. Or you receive a credit to close, it's a debit spread to open. Do I watch the gamma? No, I don't really watch the gamma. If you follow my timed expiration recommendations, it's usually not an issue. When you go under, say, 25 days, under 30 days, 25, the closer you approach expiration, your gamma number becomes bigger. And you can see that in your graph. Let me roll the date forward on this thing. Say, okay, this one is modeled out January 29th. So say we were in this thing for a while. Oh, not that far. Okay, say we were in this thing and all of a sudden it is December 16th. And maybe we're up some nice money and our gamma number is getting taller. And so the gamma is a read on the slope of this T+0 line. So, you know, in this, you know, this is a pretty big trade. I'm going to dial this back a bit so that it's more realistic for your average person. But say we had 2 5 lots on and we're up $23,000, which is a nice number. You know, and then the market dropped out from under us. That 23 could go to very little real quick with a big move. Now it would take a big move, but it seems like, you know, anytime you're up a huge number, there's some event happens to cut that number in half. So that's why I say just take the money when you've got it. But as far as gamma goes, well, I'm still not seeing a huge number there, 0.83. But as we approach expiration on this, it gets bigger and bigger. So I don't worry about gamma too much, though. If you go on and get out with 30 to 20 days to go, gamma is not going to be a huge issue. And let me see what else. Where are we? Are you going to hold your calendars over the election? At this point, I'm thinking yes. Maybe I'm foolish, but I'm thinking yes. I think if things do go crazy over the election, that I feel like the increasing volatility will bail me out, much like it did over the COVID crisis. You know, I am moving farther out in time, so I'm already in December, January spreads, and I may even move that on out to January, February. And so because I'm not right on top of of the market, you know, of the current market with these things, I should be okay. But you know, I would only recommend that for you know, experienced traders. But these things are fun. You should give them a try. Let me see. Is strike always at current, or do you ever offset for anticipated move? Yes, I will offset these things for anticipated move. Usually I put them on at the current pricing, but seems like anytime we get a huge move to the downside, there's a corresponding move to the upside. And part of that is probably the Federal Reserve bailing us out every time, which is a whole nother presentation. But you know, certainly you could play these directionally. And anyway, Liz and Jenny are not to be taken seriously. Yeah, you know, I mean, you could do small little plays with their ideas if you feel like it, but that's not really my thing. Let me see. So anyway, I'm not going to talk them down though. They're kind of cute. Let's see. What else? Do these trades use a lot of margin? Yeah, I mean, you have to put some money to work. Like I said, I'm trading 10 lots in the SPX, and sometimes I'm doubling that up to 20 and 30 lots. So that's a pretty good chunk of money. And I'm trading in Reg T accounts, so you know, it uses it all. If you had a portfolio margin, I'm sure you could use less of your capital. But you know, maybe you don't want to trade that big. So let me see. Should we sell out of at the money or out of the money strikes? I mean, I'm usually selling right at the money, or slightly behind the money. You know, but like I said before, I just don't like to sell options that are in the money. Let me see. Yeah, on calendars, no margin beyond the debit paid, which, you know, makes the math real simple on these things. So let me see. Don't forget to reset your vol parameters. Good thinking. Let me see here. Yep, let's do that. Good thinking, and let's reset our date. Well, it's on the 22nd. Have you studied brokers who are effective on margin, both Reg T and portfolio? You know, I'm mainly trading retirement accounts, so you know, this is all deferred tax money. You know, I don't have to pay taxes on this till I am retired and I take it out. So for the most part, I'm fine with the Reg T. If I can make 100% on my money every year, trading Reg T, you know, what's not to like? So I don't really need the portfolio margin.
Hey, Mark, can you explain a little bit about?
Okay, who is speaking, please?
Oh, sorry, this is Ryan. How you doing,
Oh,
Don?
go ahead, Ryan. Sorry.
Can you explain a little bit about how you traded during the COVID collapse? Were you very aggressive in rolling these things? Did you kind of weight them based on delta theta to become delta neutral when you did move them?
Yeah, I mean, just the same rules I've kind of presented here. It was really my roadmap to the whole thing. You know, I didn't know that this was going to happen, that this COVID was going to happen. And even when we first heard about it, it was like, well, you know, we had SARS a few years ago, and you know, a few years ago, we were all going to die of Ebola, you know. So when I first heard about this, I was like, oh, well, you know, you know, maybe a few people get sick, but I didn't know the extent of it, so I just was doing what I always do, and I'm keeping most of my account in these and just keeping it far out in time, and I gain a lot of comfort from this flat T+0 line. That's what I'm always going for. So many people make the mistake of looking at their expiration graph and going, oh, that's that's where I need to be, way up here. But really, you almost ought to, there's a way to turn off that thing. Well, this is your scenario. I don't know that I did that right. But no, I just did what I always do, and I've kind of outlined it here. Now, when we did take the big dive and my graph expanded huge, there was at one point I took profits because I was up so much money. I was like, I can't let this money slip away. So I took profits, and then I did bias it to the upside once we were bottoming out. Let me see if I can pull a chart up that shows some of this. Daily, 1 year, let's see, where is it? Let's do 1 year daily. Okay, I'm on 1 year daily. Where is March? There we go. I don't know. Got a lot of stuff on here. Anyway, we took a big dive here. I just used the same rules that I've presented here to try to stay on top of it to the downside. So there was some adjusting on the way down, but my graphs got so big that I felt a lot of comfort in it. And when we reversed, I really expected us to do a little dead cat bounce and go down farther. And I was totally wrong on that. Once we bottomed, it was just pretty much straight back up. But because you're riding up and down that really flat curve, and it was like this, even when the market was crashing and we were going through huge moves. I mean, I remember nights looking at the after hours move on the S&P, and it would be up or down 100 points, like, and we don't know what's going on. We're seeing crazy stuff on the news, and hearing stories of people dying all over, and burning bodies in China. I had no idea, but basically just following what I've presented here, that because you're on this flat curve, it gives you a lot of time. If you're up here and all of a sudden you're way down here, and maybe you're down $600 on a huge trade, go on and layer on the bottom if you think it's going to continue. But I mean, it's a little bit of an art. It's not totally rules based, because there are no rules in this world for COVID and crazy tweets and all the other stuff that's happened this year. So I've been able to stay on top of the moves from this year using these rules, and just been fine. It's been great. Just the timed expiration is key too. Like I've generally said, start your short leg at 60 days and your long leg at 90 days. If you map one of those out and you're risk averse and you're saying, well, I'm seeing a little bit of slope I don't like on the T+0 line, move your trade out. So this one I've modeled out is January 29th. So let me see what that 29th is 100 days. Oh, that's your long leg. Hold on. The short leg is December 31st. So I think this is your typical new entry. Where is it? December 31st is 71 days. So the rule of thumb is from 60 to 90 days on the short leg, and the long leg is 30 days beyond that. So if you model one out for 60 days and 90 days, and you feel like there's too much slope on your T+0 line, you can push it farther out in time, and they still work. There's still time decay to be made out with 90 days to go on the short leg. That's you know, makes this line even flatter. I mean, it's pretty flat in this graph, but let me just do another one. Say if I was, Tasty Trade teaches people that there's all this money to be made at the final days, and you want to start, I don't know what their current recommendation is, but say November 20th. So let's change this short leg to November 20th. And that is 29 days, and then 30 days beyond November to December 20th. So let's go December 20th on this leg. Where is it? Right there. Okay, and go back to our graph. And what's going on here? Why? Oh, let's undo the padlock. And let's move this back down to at the money, 34.30. 34.30. Okay. I mean, that looks pretty good too for a new entry, actually, but I've seen them with 30 days to go where there's a lot more slope to this line here. This actually, okay, we're in an unusual time because of the election approaching. Volatilities on November are still pretty jacked up. This may be a good trade, but as far as my safety trade, I would just do it farther out. This could possibly be a good trade because of the jacked up volatilities on November, which are probably higher than December right now. But you can map these out at different times and see a lot more slope to the T+0 line. And then I'll look at that and I'll think, well, I don't know if I want to put $50,000 into that trade when, a 40-point down move could have me down $2,500. So the way it's presenting right now, like I said, we're in an unusual time. Another consideration that I do with these is looking at the total debit for SPX. I've traded SPX enough to have a gut feel for what the debit ought to be at my preferred timed expiration. And generally, it can be as low as the low 20s to the upper 30s. But if it's above about $35 or $36, I'm feeling like I want to be farther out in time. So let's see. Let's make this one 34.30 also. 34.30, and look at the pricing difference. So this one is longer to expiration. So the short leg is December 31st, which is 71 days. So look at the pricing difference, 26.60 versus 33.50. So, I guess my thinking is I'm liking the way this chart looks. The pricing's a little high. I guess it depends how much money I'm putting to work. I work with some smaller accounts where I need to build them up quicker. My bigger accounts, I've got enough horsepower to where I can just put on these trades with 70, 80, 90 days to go and let them sit because I'm safe over this huge range. See this graph here, if I'm looking like this the day before the election, I have a lot of confidence that we're not going to go beyond these extremes. So anyway, that's some of my thought process here. But yeah, if your debit becomes too big, say over $36 or so, you probably want to go on and move it out to a farther expiration. The closer in these are, the bigger the debit, and that's, you know, just money out of your pocket and puts you in a riskier trade. So that graph there just looks beautiful to me. And so, you know, why wouldn't you want to put a 20 lot on there, you know, except for the election? You know, I'm probably going to scale down my sizes for the election, but I'll probably keep some of these going just for sport.
I think, thank you, Mark. I think you've gone through the questions as they're currently listed on the transcript. Maybe we can see, is there anyone else who wants to make some longer comments? If so, please do so, and we'll get Mark's reaction. Maybe Ryan or Ron, do you want to share some thoughts? John, go ahead. Can you? He was first. Yeah, please. So, do you want to unshare for a second, Mark, please? And,
Sure.
John Wimbush is going to share something.
Let me see. How do I do that? Let's see. Stop share.
Go ahead and share, John. John Wimbush.
Can you hear me?
Yeah, we can.
Super. Give me just a second to get the screen up. So, Mark, first of all, both of your presentations have been fabulous. And it was your first one that got me into looking at the calendars a while back. So I feel like I owe you more than one beer the next time I get back to Raleigh. But I'm in Albuquerque now, so you may have to wait a little while. But a few months ago, I did some back testing on the rut, and you can ignore a lot of what you see in this first one. I was looking at years that I had forgotten how things traded. So I was looking at 2013, 14, 15, and after 15, I just got tired of messing with it because it was winning so much. I had some criteria about how many percent up or how many percent down. And on 13, it was back testing at 147%, next year 54, next year 54. And to say, I just got tired at that point. So I found that super encouraging. And as I say, I had different rules. And so the reasons for my exit, things in here, the days in trade that I had, whether or not I had to do an adjustment or not. And then I was messing around with other things just to see if I could correlate better ideas about whether to get in or not, but I never, so you can ignore all that, it didn't matter. But I came away with it verifying in the back test just what you've been saying. It seems like a very resilient trade, and there were some challenging times during that 2003. Now, having said that, I'm going to show you a really embarrassing thing I've done here. I'm in the middle of a trade that I'm not really happy about. In the back testing I did, I was using your recommendations with the 2 and 3 month. And I thought, okay, volatility is really high right now. The tent is really wide. I think I'll try a little bit lesser time frame, which I did. So I entered one on the SPX on October the 2nd, when the market had been going up a little bit. It had gapped down, come up, down. And I thought, okay, this looks sort of reasonable. It's at moving averages. I think we're all cool here. So I entered the trade. And after that, as you know, the market decided that, I don't know, it had taken steroids or something. And we got to where I was needing an upside adjustment at this point, which I made. And during the time of getting into the trade here and watching this happen, the volatility resulted in my trade getting pretty underwater. I had a 2-lot SPX, and it was toying with the 10% down. Now my back testing had been based on 20%. So I don't like losing that kind of money, but that's what I'd done in back tests. So I just thought, we'll wait and see. made the adjustment. The high came, I made the adjustment here, and the high actually came that day, and then it started backing down. So I'm just going to show you, here's the embarrassing part. Here's what it looks like now. The T0 is, even at its highest point, is still in a 2-lot. It's showing $1,000 down. I did something else that you talk about doing adjustment at the money when you're doing it, which is also what I back tested. But at that time, with that market going just so relentlessly up, I had no idea, when it gets into a parabolic up, you have no idea how far the thing's going to go before the inevitable happens and it breaks down. So I put this tent pole a little bit out of the money, and that's why I have such a big sag here. Anyway, just to say, this trade has been underwater since day 3. And it was underwater due to the volatility getting crushed as it went up during this time. But now what's happening now is backwardation took place. And so even though the time decay has been helping me, sorry, wrong place, the time decay and the theta, and I have a good delta theta here, but the backwardation's been hurting me. And this is really illustrated in Interactive Brokers with their volatility lab, that I placed the trade right here. And so you see the volatility was up in the 27-ish range. I had a nice couple of days, and then here's when the T0 just started going crazy down, and I'm losing money. And then we get here and I'm feeling good. It's starting to feel stable. I think it's going to come back. It has stayed nicely under the tent the whole time. And then we go into backwardation here. So you can see the December is the thinner line on top. The December is now on the bottom, and the November has gone on the top. So my trade still persists being terrible. And now I'm roughly 30 days DTE. But I'm still very nicely under the tent. So of course I'm having to ask myself every day, as you say, how far DTE do I go before I bail and take the loss and reposition? My own opinion of the election, I think backwardation is happening not because anyone's predicting who the winner is going to be, but they're predicting that the market's going to react hugely one way or the other. And if you think about 4 years ago, the futures thought Hillary won and the market tanked. And then they thought Donald won and it went up, but you had backwardation based on both thoughts. I mean, not backwardation, sorry, you had volatility based on both thoughts. And I think that's why we're in backwardation right now, is that the front month is representing the election and people are going nuts with it. Anyway, that's my terrible case study of what can go wrong if you're if you get hit by both the volatility drop and the backwardation.
Well, John, do you think that has it left a bad taste in your mouth for counter spreads in general?
Absolutely not. I kind of consider a losing trade to be tuition. And if I have to bail with this and lose, I think I forget now, it's down $1,300, $1,400. Okay, so that's tuition I paid to learn that Mark's probably right. I should have gone 2 months out instead of 45 days. And that probably placing a trade this close to the election might not have been my smartest move.
So you think that you could have avoided that if you had placed it further out in time?
Or just not traded at all. So, I mean, if you think about it, you've got the uncertainty of who's going to be elected. You've got, are we going to get a stimulus passed or are we not? Have we got a second wave of COVID? All the states are showing, I think 48 out of 50 states are showing it. And, I was like what Mark said, I really felt we were getting a dead cat bounce and going back. So how much of this volatility is attributed to people thinking COVID's going to rise again and it's going to head all back down? I just think high volatility like this is, risk is higher. And the stuff that I've been reading in the last month about backwardation is that the thought of that is that risk is on. And that's the reason the front month becomes so much more expensive than the back month, is that traders are seeing a lot more near-term risk. And I think we're definitely in that environment. So I don't know that I wouldn't have placed the trade, but and it was only 2 lots. I'm glad it wasn't of size, but I guess I'm just wondering, Don, if there isn't a time where you kind of look at what's going on around you and decide to take a little bit of risk off versus risk on.
Mark, would you care to react to that?
Well, John, I looking at your trade, you look like you're a little far. The two trades are a little bit spread because you're getting this sagging in the middle of your chart. But what I did notice is your Greeks still look fine, and you're still nicely under the profit tent. And I've had this happen too. It's usually kind of rare, although it has happened this month on some of mine as well, with this dropping T+0 line. I'm hanging on in my trades. Actually, the ones that dropped, most of them have recovered. The Russell, got a few in IWM, which have not come back, but the Russell has come back, strangely enough. But, you know, like I said in the presentation, you know, usually it's the wrong move to try to manage according to your P&L. And I know you're drawn down on the trade and you're getting a little panicky about it, but you're nicely under the profit tent. The two calendars look a little spread out. I would almost add a third one in the middle, but
Well, that's not a bad idea. I like that.
Yeah, a third one in the middle would jack up your theta number too.
Yeah.
And you could still, I mean, you're not too far directional there with your delta. So you might consider adding one in the middle. But I think you're going to be okay if you'll just wait it out and be patient. A lot of trading is being patient.
Yeah, and I'd say my biggest worry is just the DTE. But coming back to this, I'm kind of a fan of the Bollinger Bands, and I think my thesis is that they're going to stay tight until we get either an election result or a stimulus answer one way or the other. So I feel like we've got a number of days of safety ahead of us. That's my thesis. So I like your idea of putting one in the center. I think that's good.
Yeah, I think so. But I mean, the trade does not look horrible. Although it's not ideal. Usually they don't go this wrong. Usually I don't get the dropping T+0 line, but it can happen. And anyway, I would think about adding one in the middle, possibly.
Yeah, I appreciate that. I found in my back testing, I never found any that dropped quite that much. So I figure these are strange times. Anyway.
Yes, definitely strange times.
Yeah. Anyway, again, I just super appreciate your both of your presentations. I think they're spot on, and I'm with you. I think this is an incredible strategy.
Well, thank you. Thank you.
Very good. Does anyone else want to share a screen or just elaborate a little bit more on their own approach to trading calendar spreads? Has anyone traded calendar spreads and been totally burnt so badly that they've had it with them? And anybody who feel free to speak up or share your screen. Ryan, do you want to talk about your experience a little bit, or?
Sure. Yeah. Thank you, Mark. And since we spoke back in, I think it was August timeframe, and you showed me some of your trades and success you had over the summer, I put on a few myself and had pretty good success since then. I mean, it's just a handful of trades, small sample size, but I think it was up around 22% on one trade and 36% on the other. I think the first trade was around 20 days in trade, and the second was around maybe 40 or so days in trade. But it worked out pretty well. So, you know, and then I put one on a couple days ago that is down a little bit because we had this pullback here. So I'm thinking about adding another lot onto the other side, just like you explained. So yeah, thanks for the guidance. Going well.
Well, cool. That's great. Good to hear.
One thing I do like to do is, as you were showing on the screen, just kind of changing the months around, you know, comparing the December versus the January versus the February, and looking at what the risk is. all right? And then comparing that to the reward or the maximum amount that you possibly can get in the trade. And that, sometimes I've noticed that on certain days, you might have a really great risk reward opportunity there. And that might be a good day to get in.
Well, I'm always looking for ways to optimize this. I'm sure that there's something could be done with the interplay of the volatility between the front and the back leg, but I haven't totally cracked that nut. But generally, it's worked just to not worry about it and watch your delta theta ratio, and don't watch your P&L too much, because certainly on a big trade it can swing around, and you may panic out of a trade if you're down $3,000 on the day, but you could look at your delta theta and be just fine. And so like I said, time heals all wounds usually, not always, but usually. Really, the times I've taken losses this year has probably been only 2 or 3 of these, and they were only losses because the market moved so much that I had to reposition the trade. And so, it can be a strategic loss to take a few percent loss on part of it to reposition that money back on top of the market. And usually I make any losses up very quickly once I've readjusted the trade. So anyway, that's just more of my thinking on this.
Ron, do you have any? You have a lot of experience, I'm sure, with these trades, with calendar trades. Do you have any thoughts on this?
Hey, there's a lot to unpack when it comes to calendars. Geez, where to start? So they're far more jumpy, let's just say, than traditional single expiration trades. So if you're not used to trading calendars, definitely backtest them first. You need to get used to the fact that they're more volatile, essentially, from a T+0 perspective. It's also got more variables, just like with option trading. When you start off, you start getting into options, you start understanding the Greeks a little bit, and then you realize it's kind of like peeling layers of an onion, right? And you slowly start to understand, hey, there's more to this. Now there's Vega, there's Theta, there's Delta, there's Gamma, and then maybe you start peeling even more layers, and you start realizing, potentially understanding second order Greeks and so on. Some people think that's going way too far, and that's fine. But the point is that one of the big factors with calendars is the fact that you're spanning across multiple expirations implies that a big factor in the P&L, and the reason why it's so jumpy, is because of the pricing of those two legs now essentially jumping up and down much more than they would if they were in a single expiration. So that's typically what we call term structure. And term structure changes are definitely going to be a factor. It's not a surprise to see what John mentioned, where the market goes down, that if you're essentially in a contango situation and you flip over through to backwardation, that is going in the opposite direction once you're in the trade anyway. Both legs are potentially getting hurt, well, especially the front leg, right? The short leg, because the front month is going to pop typically more on a percentage basis than the back month. That is going to cause some pain. One of the things, feel free to play with this in TOS, but what you'll find is that if you experiment with moving the IV of the front leg versus the back leg, first of all, changing the IV up and down for both legs equally, not much point really doing that, because it's just not realistic, right? That's not how the IVs will change. So doing it leg by leg, as was shown later on, is a good idea. And what you'll find, just for your own interest perspective, is that if you play with the IV of the front leg, which is the one that you're short, that will have an impact on the T0. So the T0 will go up and down. Whereas if you change the IV of the back leg, that will actually shift the entire structure, as in the expiration graph. The expiration graph will go up and down, right? So that gives you some kind of idea of how your trade is going to react based on what's going on in the term structure. Because if you're moving into a backwardation scenario, that means that the front leg is going to be getting hurt because the IV is increasing on the front leg. That is therefore going to be sinking your T0 down in general. And your back leg, the IV is increasing in the back leg, so that the back leg is increasing in IV. You like that because you're long, the back leg. Therefore, that is going to be shifting the structure up, not your T0, right? So your T0 goes down, but your structure goes up. So those two then balance out. And that's why you can get some instances where you kind of get, so like Mark was talking that in COVID, when that happened, his trade wasn't really hurt. That could have been a situation where essentially the back was countering, if you like, the effect by shifting the structure up, perhaps equally as much as your T0 was actually being pulled down by the front leg, if that makes sense. Okay, so playing around with that to get an understanding of how term structure affects the trade is a really useful thing, especially to do in backtesting. What else? Weighted Vega, Mark mentioned the presentation that I did. That really needs to click right, with people. And it's not I think the concept is easy, but it's one of those things that people just don't kind of find it hard to accept, right? Everybody, probably because, Tasty Trade and everybody else out there is always calling calendars a long Vega trade. They just aren't. And it can be proven mathematically, right? We've got, in my own community, we've got guys that have just amazing custom software that they've built from scratch. I don't know if you guys know Steve Spear, but just like a massive brain, this guy. Okay, super smart market maker, has his own system that can backtest. And I mean, anything you want, this thing can be pulled out from this across thousands of backtests. So we've verified and validated the concept of weighted Vega. It is not just a theory, it can be mathematically shown, right? Through backtesting in real life. And what you'll find is that from a weighted Vega perspective, if you can kind of picture this in your head, like we all understand risk graphs, right? So we know that the y-axis is basically your P&L and the x-axis is the change in price of SPX, let's just say. Now, if you shift that mentality to kind of thinking of the y-axis being weighted Vega, and you try and get a picture of what that looks like, what it actually looks like is the at-the-money strike, the weighted Vega is almost zero, if not zero, but then you actually get two humps to the left and to the right going up. So in other words, that's positive Vega on the left and on the right. So what that implies is that from a, let's just call it from a real world perspective of the Vega property of a calendar, as opposed to what the conventional software will tell you, right? Because they don't calculate weighted Vega at all. But if you look at weighted Vega, a calendar is essentially, an at-the-money calendar, I should clarify, starts off being Vega neutral, but then as the underlying starts to shift up or down, then you start going into one of these humps of positive Vega. Then you'll get through to a certain point. It's not quite one standard deviation, it's actually a little bit less, but then that Vega starts to come down. Not necessarily go negative, but it basically goes less positive. The other thing to understand is that the humps are relatively shallow. They're not very big. Nowhere near as big as what the conventional software will imply. So that's an interesting thing too, okay, to understand. So I noticed that in the chat, one of the people actually mentioned that long-term calendars are, the main thing is that they're sensitive to IV. That's actually incorrect, right? A 60-90 calendar will start off Vega neutral from a weighted Vega perspective. Okay, if you just look at nominal Vega, completely different story, but again, it's just not real. And again, I'll repeat the fact that we have validated this through extensive backtesting, and weighted Vega fits in really, really well.
Rob, when you say weighted Vega, are you assuming, by the way, that the person has legs in both the near and the far months?
Yeah, all weighted Vega implies is that it's a way to use a really quite a simple formula. And Mark actually showed the URL to the presentation if you want to see it, and it's in there. But it's basically 30, well, I don't know if you want to know the formula. The formula is 30 divided by DTE. You take the square root and you multiply that by the nominal Vega. That's how you figure out what the weighted vega is. So all you have to do in a calendar is you simply work out the weighted vega of each leg, because you've got multiple expirations. And what you'll find is that when you then calculate the weighted vega of the front leg versus the weighted vega of the back leg, the weighted vega is actually very, very similar. So they cancel out. This is why the at the money structures start off roughly vega neutral from a weighted vega perspective. But remember that as then the underlying shifts up or down, you now have two weighted vega humps to the left and to the right of that structure. So now the calendar will start becoming slightly more positive vega as price shifts up or down, and then it peaks and then it starts coming back down. Okay, so that's how it works from a vega perspective. What else? I guess the other thing is, I know there was a mention of, percentage returns on your trades and whatever, and that's fine, no problem. Calculating a return on initial debit paid or return on Reg T risk, that's, very normal. Everybody does it. The only thing is, remember that when you're talking about those numbers, you have to realize that that implies that if you're talking about those numbers being so-called real return, you have to be 100% invested in the trade, right? So if you basically say, I can do whatever, I heard numbers of like 50%, 100% return a year. Okay, sounds fantastic. The thing is, that implies you are 100% invested in the trade. So if you've got a $100,000 account, you are buying sufficient calendars such that all of the debit is consumed in your account. You have a $100,000 calendar trade on. Okay. If you're not comfortable with that, which I would recommend that you shouldn't be, or that's quite, at least for me, I'm quite conservative, right? I would not do that. I would not put in 100% of my entire account into a single trade ever. I don't care how good the trade is. But the second that you don't do that, then now, of course, those numbers have to be tempered, right? So if you're only investing, let's say, I don't know, 50% of your account into trades, which is still quite a high amount. Now, of course, your 50% return a year drops to 25% return on the account. And I'd suggest that people focus on that, right? Because it can be quite misleading to talk about just return on Reg T and whatever, because I think a better judge, and one that's actually more fair as well to how everybody else tends to treat it, is to think of return on your entire account at the end of the year. And there are some people that go full out and invest, like I said, their entire account into a strategy. But most of the time, the people that do that are the people that are potentially okay with a nightmare situation that their entire account gets wiped out, because they can just refund it with more money and go.
Because either it's an allocation.
I'm sorry, say that again. I broke up.
Yeah, there's certainly people who can do that, who,
Right.
let's say, are only trading income rather than assets. Only, and they don't care if it loses all the money, because they'll do it again next month.
Yeah. And that's fine. And that way you can talk about those numbers that sound amazing, right? But you have to realize that you have to be willing to lose everything too. So if that's not a situation that you're in, and you basically want to trade, more conservatively, and not lose your entire account potentially in a nightmare situation, then you have to have more reasonable numbers. But you're now focused on return on your account, not return on margin, right?
Yeah, I mean, we certainly hear these stories. There are people out there, very well-respected people, prominent people in the industry, who say they avoid calendar trades because they are just too risky. They can rip your face off. Would you agree with that?
Well, remember, we started off by saying that calendars are far more volatile than traditional single expiration trades, right? And most people, number one, don't understand that because they don't have the experience in trading calendars. So they don't know that. It's kind of like saying, riding a docile, donkey versus riding a wild bull, right? If you've never seen a wild bull, you go, oh my gosh, that's crazy. But, if you've seen a rodeo, that's how they are, right? So you go into it with eyes wide open after having done extensive backtesting. And you just know that, yeah, look, my T0 is going to jump around a lot. I have to be willing to be okay with that. If you're not, then yeah, you're not going to like calendar trading, right? So does that mean that calendars are bad? No, it's just the way they are. They're just a different beast. Okay. But one of the things you have to take into consideration is that in general, stuff that is more volatile, you tend to scale down in size, right? So for example, if you're trading something silly, let's say that you're investing in bonds, which are relatively docile in terms of returns, you can afford to potentially invest more money in that, as opposed to investing in the Qs or SPY even, right? Which is going to be far more volatile, right? You could get drawdowns of 45, 50%. We've seen that multiple times. So,
Yeah,
you know,
regulation T margin is not a guide, it's to real risk.
Yeah, you just have to understand how the trade works, what the drawdowns are, and how it moves just on a day-to-day basis. And you'll get all of that through backtesting. And I think it was John that kind of showed his spreadsheet. That was a good spreadsheet. The one thing that I would suggest, which I may have missed it perhaps, but I would strongly encourage adding maximum drawdown to your trade log, okay? So because you want to know what a normal maximum drawdown is. If you're in a trade that is wild and you see 20% drawdowns, that's okay. But at least you want to be aware of the fact that it's completely normal for this thing to draw down 10, 20%.
That's
right?
sort of like the Kalmar ratio.
Yeah, the thing about Kalmar though, well, yeah, but if you're not tracking the data on a day-to-day basis, because it's one thing to basically just look at your max loss, if you like, at the end of the trade.
Oh, yeah.
On the trades, it actually did take a max loss on, but it's very different to track it day by day and see what the max drawdown is on an intraday basis kind of thing, right?
Absolutely.
Yeah.
You really have to do mark to market for every measurement of loss.
Yeah. And again, nothing wrong with trading more wild and volatile things. Like there are people that love trading Bitcoin and whatever, but to some others, it's crazy to trade that because it's just wildly volatile, right? Calendars are not like trading Bitcoin, by the way, but they are more wild than a traditional trade. So I would encourage backtesting extensively like you should for any trade, but keeping an eye on the max drawdown because they'll typically draw down but be more wild in terms of jumpiness from day to day than a single expiration trade. And the other thing that you have to be quite comfortable with is that I noticed that unless I missed it, but in Mark's presentation I didn't see anything about a max loss level, right? He mentioned profit targets multiple times, 15%, 20%, potentially sometimes holding to more. That's fine, but I never saw anything about a max loss.
Well, let's ask Mark to comment on risk control.
Sure.
Thank you, Ron. That's fantastic. I love some of those points. All of them, in fact. Mark, how do you go ahead?
So, I mean, Ron has some very good points, and I don't disagree with anything he said. I don't know. I don't guess I have a max drawdown. I want to get away from these things before I'm losing big. I watch them close enough that I'm reasonably confident that I will be okay through most events. Maybe trading this through the COVID crash gave me some confidence because I did pretty well through that, and certainly we could have something worse. I'm not arguing that is the worst that could happen to us, but it's probably the worst thing since 9/11 that's happened to us. So no, as far as a max drawdown, I don't want to lose anything. So if I'm losing, I will usually get away from them. So I don't know if that really he likes that answer or not, but
well, I think it's fair to say nobody wants to lose, right? But
sure.
Maybe if I phrase the question in two different ways, with either your backtesting or with your live trading, what has been the average drawdown that you've seen in terms of the max drawdown? But what would the average? Actually, let's just say what's been, let's say, the worst max drawdown that you've experienced either through back trading or through live trading?
I would say the max drawdown I've seen is about 10%.
Okay.
And that probably could have been avoided if I was, played my cards differently. But yeah, I mean, certainly if you're down 10%, you should go to cash and reconsider your approach.
Okay.
But yeah.
Great, guys. That's a great discussion. Who else, if there is, oh, let's see.
So Mark, I was going to say that when we back tested this together, as I recall, you were pretty aggressive in rolling these things. You didn't let them get close
Well,
to the edge of your tent.
I am aggressive because this is what I do. And so, if I am not paying attention and let something get away from me, it hits me in the pocketbook, and it's goofing off on the job. And so, yes, I try to be pretty aggressive in rolling these things around, and maybe that's the key to doing, success at this. I'm not sure. Certainly we could have some other news items that move the market even greater, even quicker, potentially. But yeah, so far so good. I feel like if your strategy can stand up to the COVID crisis that we had back in March, that, maybe I'm onto something. I don't know.
Ron is saying, though, that you might have just been at a sweet point where the gains on the long balanced out the losses on the short, and vice versa.
Well, that's true.
But probably
So-
you can stay at that sweet point. Maybe if you move around to find it.
Yeah. I mean, certainly if I'm rolling these whenever I feel like I need to, based on, the Greeks and also its position on the graph. And it's, like I said, it's always a good move to bank profits and move farther out in time as a way to mitigate your risk. So I think being proactive at all of those things, adjusting and whatnot, are very helpful to staying on top of the ball.
Sure.
Yeah, drawdowns are no fun. So I like to not lose any, but occasionally, like John was showing, you do have the dropping T+0 line, but really I've only had that happen like, I've had that on some of my current trades, but in 2 years of doing this, I haven't seen that very often. So,
And also, as Ron was saying, if you're talking about one account or a few accounts out of many, then it's not the same thing as if one giant account.
right.
Some degree of diversification is is probably in order, whether it be even the time frames of the trades or various other diversification. John had a question in the transcript. Mark, are you using any of Brian Johnson's hedging techniques?
I usually he's got a technique he talks about with a standing order in the futures, whereas if we crash a certain amount, you have an order out there to fill. And I do some of that, and that's really the only one.
Okay.
So,
Sure. Okay, I think Brian was on actually earlier, but I think he may have dropped off now.
yeah.
He was.
I wanted to explore this dropping of the T+0 line for a minute. So if you play around with the analyzer, if you go into severe backwardation, the T+0 line can actually drop down below the expiration graph, where you're actually losing more money than you put into the trade, than the debit of the trade originally.
Exactly.
Now, it's my understanding that the absolute maximum that you can lose is the original debit.
Yep.
And that because that expiration, those lines are going to meet, and that's where you'll be, because the short and the long are going to cancel each other out from a delta perspective.
That's the max you can lose at expiration. But how about intra trade?
Sure, intra trade you could certainly, your T+0 line could be much further down. But I guess what I'm saying is, if you're well below that expiration line. Like, why wouldn't you just wait till expiration and lose less money?
Because you might run out of margin and capital.
All right. I think one of the things to clarify is if, all right, so you got a short in the front expiration and a long in the back expiration. If you were to be in a trade and you then start to increase the IV of the front expiration, which you're short, it's now going to go against you. Your T0 is going to sink, right? The thing is, your max sink point, if you want to call it that, if you like, is basically just going to be the debit that you paid for the trade. So it's going to sink. It's going to look ugly, right? But, and that, you know, the theoretical nightmare situation is that you'd basically lose the entire debit of what you put on.
Why is it limited to that? Why couldn't it be larger?
Just based on the way that the actual trade works. I mean, to be honest with you, the scarier one for most people is not that. The scarier one for most people is the back expiration, right? If you then grab the back expiration and you sink it, as in you lower the IV, you drop the IV, right? You suck the IV out, your structure gets squashed down. But it's the same kind of thing. You know, we're all used to seeing, you know, the zero line and a nice profit tent above it. You drop enough of the IV of the back expiration, and the entire thing can be underwater, all of it. Even the peak of your tent can be underwater, under the zero line, right? That's pretty extreme. I've never seen a calendar be completely underwater, apart from doing weird things like owning trades, right? But, you know, in normal situations, you're not going to see that. But it's scary to see the entire structure sink. That's one of the things that people that don't trade calendars have no idea. They always think that the expiration line is, you know, like written in stone. You know, it's fixed. It will never move because it doesn't move in a single expiration ever. But the second that you do multiple expiration trades, different story, right? The actual structure itself can shift up and down. It could actually shift in your favor too. It could shift up, which is beautiful when that happens, right? But it could also sink down, and it can be scary if
Let's
you've
say
not seen.
that the expires are 2 different months.
Yeah.
Is it altogether theoretically impossible that those 2 months could detach from each other?
Well, they are detached from each other from an IV perspective. So the
Yeah,
term
but in
structure will
price
do
as
whatever the hell it
well.
wants.
And price
Well,
as
sure,
well.
of course, yeah.
Well,
Yeah.
then why couldn't the loss go to infinity?
Because it's kind of like that you're long and short options at the same time. Imagine if it's like
but the long could just go to, might not participate in, might not move with the short. I'm
Sure,
sorry, the
all right.
far.
Think of a simpler scenario like a put credit spread, right? So you've got a short and a long, but they're in the same expiration now. So you might say, well, couldn't I get infinitely hurt on that short put because it's got unlimited loss? Yes, but the thing is, you've got a long. That's
Yeah, but they're tightly
not,
coupled together. They cannot have
Sure.
a different underlying. Whereas in the calendar spread, they are 2 different underlyings.
They are. The situation that you can get in through to a really bad situation is in the instance that you allow the front expiration to expire and you're now essentially long or short a naked leg. So in the case of a standard long calendar, you're short the front, long the back, and that's why it's completely viable to do that in a Reg T account. But if you flip that upside down, if you basically do a short calendar where you're actually long the front, short the back, then the broker is going to charge you an insane amount of margin in a Reg T account because of that. Because they basically say, well, what if you forget to close down this trade and the front leg expires? You're now essentially naked short, right? Because you only have one expiration because you allowed the front to expire, and you're now naked short. So they will margin you on a short calendar as if it were a naked put, right? Which requires an insane level of margin in a Reg T account. In a PM account or span margin, it's a completely different story because the margining is different.
Yeah. It's, we could, Ryan, you started that question. You want to have the final word on it?
Oh yeah, no, I was just going to add that I just want to just clarify that you can't actually lose more than the debit paid. Even though the T+0 will shift or the tent will shift, that in the end, you're not going to lose more than the debit you paid.
I'm not convinced of that, but
yeah, as long as the calendar remains intact, as long as you've got both legs on, then for a long calendar, then yeah, the max loss is going to be your debit paid. For a long calendar, the one that's riskier is a short calendar that can be pretty weak, but for a long calendar, yeah.
I can't see why the short leg could not simply, the near leg could not go to infinity, infinite loss, while the theoretically, if the 2 months separated.
Well, because the price has to go to 0 at expiration, right?
Well, we won't settle this. I can see that. Anybody else have any other comments? We better wind it down. There's some excellent comments in the chat too. So I encourage people to look at that. Any other final comments? Thank you very much. We'll call it a night. Yes, we will have the slides available and we will have the recording available. Thank you. Good night.
Thank you, guys. Thanks, Ron.
Thank you so much, Mark and Ron and Ryan.
Thanks, Mark. See ya.
And John.